This is Warren Buffett on his investment philosophy in an interview with CNBC from a few years back.
I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I've never felt that I knew it, and I've never felt it was important.
He's one of the greatest investors of all time, and from 1965 through 2021, his holding company Berkshire Hathaway generated a compound annual return of 20.1% against the 10.5% of the S&P 500. In fact, if you had bought $10,000 worth of Berkshire shares when Warren took over, they would be well worth over $284 billion at the end of 2021. That's crazy. Buffett follows the Benjamin Graham School of Investing, which is to look for stocks whose prices are unjustifiably low compared to what they're actually worth. Since Warren has done so many interviews in the past, we actually have an exact blueprint of how he would tackle every single situation in 2023. So in 2023, we're going to see rising interest rates, we're going to see inflation still at elevated levels, as well as the threat of a possible recession. So first up, when it comes to investing in a period of rising interest rates, Warren actually has clear guidance on how he would attack the situation.
In 1982 or 3, when the long government bond got to 15%, a company that was earning 15% on equity was worth no more than book value under those circumstances, because you could buy a 30-year strip of bonds and guarantee yourself for 15% a year. And a business that earned 12% was a subpar business then. But a business that earns 12% when the government bond is 3% is one hell of a business now, and that's why they sell for very fancy prices.
What Buffett is saying here is that in the 80s, when inflation was running rampant, interest rates became closer to 13 to 15%, and that stock performance is relative to the interest rate. Since a lot of the bonds in the United States were yielding close to 15% at the time, you'd almost rather have the bond compared to a stock, because with a bond, it's less risky.
But it is gravity. I mean, if you told me interest rates were going to be 15% next year on bonds, there's a lot of equities I wouldn't want to own now, and I would buy a lot of governments at 15, and I kind of wish I had it in 1982, but I didn't.
Warren Buffett states here that interest rates are like gravity, so when interest rates are closer to zero, a lot of investors and pension funds want to flow their money out of bonds and into equities because they're more likely to get a return in the stock market. So when interest rates are low, you want to think of that as like low gravity for stocks, and when interest rates are high, that means the gravity is turned up. There's actually a famous scene in Dragon Ball Z where Goku, the main character, is training on a planet with much higher gravity than Earth. Goku in this case could be analogous to stock market valuations. When the gravity is high, it's harder for valuations to increase or Goku to jump. The opposite would be true too. If the interest rates are low, that means the gravity is low and Goku can jump higher, aka stock valuations can go higher. While you shouldn't change your investing strategy solely based on higher interest rates, it is something to keep in mind in 2023 because we're going to see some rate hikes in the first half of 2023, which means that the gravity is going to be turned up. That means there may be some stocks right now that are overvalued that are going to get corrected in the short term, as many investors are going to move more of their money towards bonds.
Well, the businesses that will perform the best are the ones that require little capital investment to facilitate inflationary growth and that have strong positions that allow them to increase prices with inflation.
So Warren says pretty clearly here that he wants to invest in businesses that require little capital investments, as well as companies that have strong positions to increase their prices with inflation. What does he mean by this exactly, and what are some of the businesses that fit this criteria? If we take a look at some of the largest holdings in his own portfolio, we can see that his largest positions are in Apple, Bank of America, Chevron, Coca-Cola, and American Express, to name a few. In terms of a business that can increase their prices along with inflation, we can think of businesses like Coca-Cola or Kraft Heinz. They produce consumer staple goods such as drinks or condiments, and as prices go up, consumers are still going to look to Coca-Cola and Kraft Heinz because they have huge brand recognition, which is a huge competitive advantage, as well as a scalable distribution system and strong positioning within their respective markets. In terms of businesses that require little capital investments, we should think of businesses that you need to just buy once and then they continue to produce cash flow for you in the future. Businesses like utilities or railroads just keep eating up more and more money and require a lot of capital, so they do not fit that bill, and that's because to make profit, they have to continually invest in their business. Instead, we should look for companies companies that can increase their earnings without having to produce more products. So if you think about a gaming company that sells in-app purchases, and I used to work at a gaming company that sold in-app purchases, the cost for more products to actually come out is zero. Since in-app purchases are literally just pixels on a screen, maybe I'm selling you an extra life, I could literally just create that out of thin air, and guess what? You'll be paying some money for that. Therefore, a gaming company's margin is very, very high, and that could be a reason why Warren Buffett has some gaming companies in his portfolio, such as Activision Blizzard. Now, gaming companies tend to be the very extreme side of that spectrum because they have zero marginal cost of creating a new product. But some other companies you can think of are like Visa or American Express. As their transaction volume increases, so should their bottom line, especially in an inflationary environment. If we're all spending more money to buy the same goods, then it's likely that these companies stand to benefit as well. In terms of investing during a possible recession, which is quite likely in 2023, here's what Warren Buffett has to say.
If you worry about corrections, you shouldn't own stocks. I mean, if you can't take your stock going down, it's going to go down sometime if you own a stock, so why worry about it? I mean, the point is to buy something that you like at a price you like, and then hold it for 20 years. And you should not look at it day to day. If you bought a farm or apartment house, you wouldn't get a quote on it every day or every week or every month. So it's a terrible mistake to think of stocks as something that bob up and down, and that you should pay attention to those bobs up and down.
Warren believes in buying stocks for the long term, no matter the price, and Warren actually produced an op-ed after the financial crisis of 2008, which he detailed his strategies. He said, quote, "In short, bad news is an investor's best friend. It lets you buy a slice of America's future at a marked down price. Fears regarding the long-term prosperity of the nation's many sound companies make no sense. These businesses will indeed suffer earnings hiccups, as they always have, but most major companies will be setting new profit records 5, 10, or 20 years from now." He goes on to say that in the 20th century, we endured a lot as a nation in the United States. We endured 2 world wars, a depression, a dozen or so recessions, yet the Dow still rose from 66 points to 11,497. He also states that some investors actually lost money because they, quote, bought stocks only when they felt comfort in doing so, and then proceeded to sell when the headlines made them queasy. Sound familiar? So yeah, he likes to invest in great stocks, but what are some of his investment philosophies when it comes to picking great stocks? That's what we need to know. In a 1977 annual shareholder letter, when inflation and interest rates were close to 10%, he stated, quote, "We select our marketable equity securities in much the same way we would evaluate a business for acquisition in its entirety. We want the business to be one that we understand, with favorable long-term prospects, operated by honest and competent people, and available at a very attractive price." So let's actually break down these 4 things that he's looking for. Number 1 is pretty self-explanatory. He wants to invest in companies that he understands. A famous example of a company he did not understand at the time was IBM in the 80s and 90s. He stayed away from it because he just simply didn't get the business model. Number 2, he says he wants to invest in companies with favorable long-term prospects. But what does that mean? What he's referring to here is a company with a large competitive advantage or a large moat. A moat is a term that refers to a business's ability to maintain competitive advantages. Just like a medieval castle, you're going to have a moat around your castle to protect yourself from potential attackers and invaders, and that's kind of what a company wants as well. They want a moat around their own company to protect against competitors. An example of a company with a really wide moat is Google. So they actually own 92% of all internet searches, and guess what? They're selling ads on all of those searches. So if you are an investor in Google, you're pretty happy because you know that if anyone has to go to advertise on search, they're going to Google. Number 3, he wants businesses that are operated by competent people and honest people, and this is pretty self-explanatory as well. You want the people to be aligned with the mission of the company in order for success. And number 4, you want it to be available at a very attractive price. I've said this before in many videos, but Warren and his team look for companies that have an intrinsic value above what they're trading for. The intrinsic value is a measure of what the asset is worth. So in simple terms, it means what is the business worth to us? Warren looks to buy good businesses at a price that's way below their intrinsic value in the hopes that the market will realize it over time. Even though he wrote this a long time ago, his investment philosophy hasn't changed, and these simple strategies are still how Warren Buffett chooses to invest today. Lastly, one more important point by Warren Buffett is one of the best investments that you can make overall. Listen to what he has to say here.
The best thing you can do is to be exceptionally good at something. If you're the best doctor in town, if you're the best lawyer in town, if you're the best whatever it may be, no matter whether people are paying you with $1 zillion or paying you, they're going to give you some of what they produce in exchange for what you deliver. Whatever abilities you have can't be taken away from you. They can't actually be inflated away. from you.
And this is some of the advice that I resonate with so much. If you consistently invest in yourself, those skills will never go away. A lot of people think that building wealth is just a function of investing consistently. Now, while that is true, if you can grow your income and your skills alongside it, then you're going to have a lot better time and an easier time building wealth in the future. Yes, you can make $1 million over the course of your life investing your salary, but what if you double or
the
triple
primary
or
task
even
of the
quadruple
investor
your
is to
salary,
consider
you
if
would
the
get to
stock
$1
has
million and
good
way beyond
fundamentals to
even
begin
faster.
with.
So I
If the
absolutely
company
agree with
is
him here. And one of my
wonderful,
goals on this channel is not to educate
interpret
you on
Warren
just
Buffett's
markets
value
and how to invest, but also